better to be a live chicken than a dead duck. There's too much happening on too many different fronts, politically, socially, economically. We've had almost a 4-decade bull market in bonds that ended a few years ago. We think the same is coming true in terms of the general equities here in the U.S. And it's going to be more important for preservation of capital than capital appreciation. That doesn't mean that there aren't areas that you can make money in and try to double or triple your money. And obviously one for me is the metals. But I think overall, no matter where you're at, but particularly for U.S.-based investors or people investing in U.S. assets, I think bonds have clearly seen their best days already, and we're seeing the best days come to an end here in the U.S. general equity market. First, I think it's very important, and we don't have habits for those of us who play equities in general, whether it is metal stocks and all, to recognize how much bigger and more important the U.S. bond market is to the U.S. stock market. It's very rare that the U.S. bond market moves based on something that happened in the stock market, but it's much more common for the stock market to move based on what's happening in the bond market, meaning that if interest rates are declining and bond prices are going up, that's usually favorable for the stock market and gives it an underpinning, and vice versa. So I think the first thing we should do is pay more attention to what's happening, including myself, what's happening in the bond market, but not just here abroad. In Japan, they have even a more serious problem at the moment than we do. Our perception is better. We have as much problems overall, I think, when you look under the rug, but their perception is a lot worse because of how low and artificially their interest rates were kept for a lot of years and how dependent self-financing has become in Japan, where basically the Bank of Japan has been the main financier of its own debt. But I think what's important to understand is that we have a lot of debt coming due, first of all. We have $9 trillion coming on the Treasury side, and then we have a bunch of corporate and, of course, consumers getting more indebted at a time when things are minimally in the U.S. slowing down. There'll be an argument, and we won't know who won the argument 6 to 12 months from now, but there's an argument now that if we haven't slipped into recession, we're on the verge of. We're continuing, as you and I speak, continuing seeing things slow down in all areas. Home sales, car sales. A lot of it has to do with the tariff, and as you and I speak, there's like another log thrown on the fire. And who knows by the time you air this how many more logs. But the fact that since there's no clear remedy on the tariffs, businesses can only do one thing. They have to sit on their hands. I have a lot of small business owners as clients, and they're perplexed what to do. It's almost every day. And the best choice is to do nothing till you get a clearer picture. So I think to answer your question is the bond market is far more important than the stock market. And if I'm a betting man, I'm betting on interest rates going up, not down, not only here, but also in Japan. Well, what's left of them, they are getting squeezed from all ends. We just saw an interesting statistic. I thought it was one of the most enlightening number that I did not know to the actual fact that the Secretary Treasurer gave out 2 months ago. And he noted that the 10% wealthiest Americans own 86% of all the assets in America. And the next 40% own just the 14% that's left, and half of America doesn't own assets. So the middle class falls somewhere's in the know or just a small part of it. So I think they're being hit from all sides. And what's lost in this, when I hear people talking on our financial networks here in the States, they're always talking about, hey, what is IBM doing or what is some high technology company doing? But the backbone to America's economy is the small to mid-sized business owner. And they'll tell you almost to a person that in the last 20 to 30 years, not just now or the last administration, there has not been good legislation towards the small to mid-sized business owner. And with everything else that's happening, that's another reason why I don't have a bullish outlook, because economically the backbone to America is just getting to the point where many of them just want to get off pulling the gravy train and try to get in the wagon, which is the gravy train. I think what will happen is as the general equity market slows, and I'm not in the camp that thinks there's going to be a big crash in the stock market, but I also don't think it's going up a lot. Wall Street will always find reasons to buy something. It doesn't know how to do nothing. And what will happen is the generalists out there will start to see that the only real sector that's pushing out these record quarterly reports are these gold producers. And we're starting to see that now. We're starting to see some of the main brokerage firms and main people, big hedge funds buying interest in gold companies, talking about gold stocks. We've even seen it in uranium with Goldman Sachs getting involved. So I don't think major producers have reached a peak. Where I have decided to focus, because I played the actual physical bullion first, I played the majors, and I several months ago and in the last few months put as much as I possibly could without getting a divorce into the junior resource sector. And even there, we're seeing now a lifting. So it's all systems go at this point. Yeah, they may get points where there's some consolidation and profit taking, but I think that market it's probably in an earlier stage than even the physical gold price. First of all, almost half of all financial advisors in the United States right now weren't even born when I started 41 years ago. The bulk of them have been only since the millennium started. And the reason I bring that out is, other than one or two short but significant declines, it's been a one-way street if you've been a financial advisor. So you can understand their buy the dip mentality, because so far each time it's worked. And it's in the same mode that it is now. You buy dips like what's occurred there. So it's going to take more than one dip before that breaks the camel's back in their eyes. Those of us with gray hair or no hair, meaning that we've been in this game for decades, the market that we were once involved in doesn't really exist anymore. In 1984, when I started, almost 90% of the trading was just retail investors. And those were people that were just buying stocks to be part owners or selling of businesses. And only 10% or so was institutional, and there was no computer trading of any type whatsoever. Now, over half the money that's in equities is in passive funds. And these are funds that are tracking indexes and indices where the manager, he or she, only has discretion to purchase certain stocks that make up those indices and keep tracking whatever that index or indice is performing. It's not any room for individual, well, I won't buy as much of this or sell this. And that has, in a sense, self-fulfilling prophecies. As more money kept coming into these funds, the manager couldn't even say, no, let me hold some in cash. No, they had to put it to work. And a lot of it was concentrated in the higher echelon technology in the S&P 500, which happens to be the biggest index that is used in these passive funds. The issue with that is one day the reverse will happen, and the manager's not going to be able to go, no, I don't want to sell these stocks. They're too good. They're going to have no choice. That's very, very important to understand. And then think about where the other half of the money is. I would argue 2/3 of that remaining half is in computer algorithm trading programs. Some as simple as trading based on words used in headlines to trigger programs, to some very sophisticated that will use all sorts of delta spreads and options and futures and simultaneously selling. Those old Grandich guys with no hair or gray hair, they make up a smallish part now, retail, that is still buying stocks for part ownerships of businesses. So I think the first thing most people have to do now is get out of that mentality from 30 or 40 years ago and understand the game and what the board exists now. For instance, in our financial shows networks here, they're being shot from the New York Stock Exchange. That might as well be a museum, because so little of the trading actually takes place there anymore. And so I think we have to understand how different the game has changed and what influences it. And therefore, to answer your question about, will the stock market ever go down or whatever, I think we have to look at a couple things. One, go back to what the Secretary Treasurer said. Who owns the assets? The top 10% of wealthiest people own most of the assets. That means they also own most of what makes up the stock market. What's interesting of late, in these last several months, going into the latter part of last year, it shows the very, very wealthy are been selling U.S. assets and parking them elsewhere. I think that's interesting. The second thing I think that's important going back to is that what I said earlier, most financial advisors really are one-way street drivers. So far, that's worked for them. Someday, for some reason, it won't work anymore, just like it stopped working in the bond market. If and when that day comes, the lack of experience to know suddenly how to drive on a two-way street, or your first time that you're approaching a traffic circle or a roundabout, that's probably going to cause more downside pressure than otherwise. So like I say, when I combine that all with my other economic, political, and social aspects on how I look at the markets, I think the U.S. stock market especially is fully priced and no reason that I feel I have to chase it. So at the beginning of the year was my favorite metal. My forecast, if you want to call it that, was 4 to 4.5 in the first half and 4.5 to 5 in the second half. And it's surpassed that. It's gone higher than even I imagined at this time. I think part of that reason is because the fundamental argument is still so strong for it. And it's a slow but steady working its way higher. There's no question that we are going to be in a deficit, some expect as early as next year. We're still not seeing real hard money going into new discoveries and new growth. And those projects that are still out there in the world, grade is shrinking, more cost to bring it out. And listen, majors are not about to spend billions of dollars now in the same way they did 20 or 30 years ago because of all the social and political issues that are arising in different parts of the world, especially where copper used to be one of the metals that you would eagerly go to those places to find and develop. So it has a very, very bullish stance. I just think it's going to work its way higher and eventually get and stay above 5. And some argue that we'll need to get above 5 and stay there for a while before any real serious money gets put into looking for massive new supply. And by then, the supply and demand scenario will be so bullish, it'll be a self-fulfilling prophecy in order to have that high price. But I think for now, it's just trading really well. And what's interesting is even big gold producers who used to just talk gold, only gold, they're now got very much into copper. And one of the reasons also is that these gold copper deposits, one company that I own, it's almost split 50-50, and it allows you to develop the copper at a much lower capex cost because of how high the gold price is. So copper combined with gold and copper on its own, to me, is still a very, very worthy place to look.